Welcome to the Real Impact Podcast. I am your host, Kyle Troyer. My goal is to talk multifamily real estate, help you think bigger and take action on your goals, and give you tips on podcast creation and strategy. Please follow, like, and subscribe, and leave a review. That would mean the world to me. Share with someone that could benefit from this podcast. Hi, and welcome to my Passive Investing Masterclass. Thank you for being here. First of all, I want to make a disclaimer. I'm not a tax professional. I'm not an attorney. So whatever I share today is for educational purposes only. Please consult with your tax professional or attorney before making any investment decision. So who is this the right fit for? If you're a busy professional that doesn't have time to find real estate deals, to operate them, to manage them, but you have capital to deploy, I think this is a great opportunity for you, and I'd love to talk more about this with you. I want to say this a lot in this episode, but go over to my website. I think you'll find some great resources there. I haven't linked it down below. You can find everything you need there in regards to multifamily investing. So let's get into it. Now that we've got all that legal stuff out of the way, let's talk about passive investing and what is the difference between passive and active investing. As a passive investor, you're relying on an operator or a lead sponsor to operate the deal, find the deal, close it, manage it, everything from A to Z. And you as the passive investor are only providing capital for the deal, and then you can sit back and watch the cash flow roll in. What you're not doing, you're not dealing with tenants, toilets. You basically have no stress regarding the involvement of the property. The downside to this is you have no operational say as you are completely passive. What you are doing, you're placing capital with a professionally managed real estate asset with an operator, hopefully that has some experience, that has done this before, and knows all the risks that go into it and are able to mitigate those risks by different systems they have in place. There's different vehicles. As a passive investor, you could invest into a syndication that would be directly into a lead sponsor's deal. You can invest into a fund of fund, which is a fund that invests into a lead sponsor's deal, or you can invest as a JV partner. Now, a disclaimer here, JV partner is supposed to have some operational say in the deals. You're not allowed to be completely passive as a JV partner. Consult with a tax professional or CPA or an attorney before making any decisions here. Let's talk about how it works. What do you do as a passive investor? First of all, you have to find an offering to invest in. You can do this through networking on LinkedIn or finding companies through Google searches. There's different ways to go about this, but first of all, you have to find an actual offering to invest in. Learn about the deal. So we'll talk later about some risks, some red flags to look for. Next, you want to review the private placement memorandum or the PPM, the financials, the business plan. After that is of course after evaluating the sponsor, making sure they're a legit operator. Next step is to subscribe to the deal, which would be logging into your investor portal, making all the signatures on documents that you read through. There's a ton of documents to sign, and then after that you wire your funds or send an ACH payment, and you're now a passive investor on an apartment deal after it closes. Next, you'll receive updates on the deal. Hopefully soon the sponsor starts making distributions to your bank account. So this would be the cash flow that comes from the property operations. Updates are normally on a monthly or quarterly cadence. You'll probably receive an email newsletter just giving you some broad overview updates of the property to help you know what's going on. As passive investors, we want to be passive, but we also want to know what's going on with our capital and how it's being used. An example of a property, of a structure, how it's done. Typically, sponsors or operators look to hold for 5 years and return their capital back to investors to be able to do what they want with the capital, either put it into another deal or maybe they have some other things they want to use the money for. But the goal is to return the capital in 5 years. Some example metrics, and I have linked my website down below. I think you'll find some great resources there. Click on the link and you'll find a cheat sheet for different investor lingo, and you can find these return metrics there as well. And an explanation of each. In many of our target deals, we aim for a 6% plus cash on cash return, a 15% IRR, a 2x equity multiple, and an average annual return of 18% or better. And again, this is just projections. This is not guaranteed or promised. And again, you can find all of this information on our website. I think you'll find great value in that. If you're a seasoned investor or someone brand new to multifamily, I think there's something there of value for you. So your role as the passive investor is to vet the operator. There's a lot of questions that you might have for the operator to make sure they're legit, to make sure the deal is actually a deal, because it can be easy to make a deal look good on paper. And so if you don't know what to look for, you might invest into a deal that actually is not a good deal at all. So there's different things to look for, or you can partner with a fund manager who does all of that for you. And that's what I do as a fund manager, is I vet deals and sponsors for you, so you don't have to lower your risk, your downside risk is basically what a fund manager does. And we're also possibly able to get better terms versus, let's say we write a check for $1 million as a fund manager. We might be able to secure better terms than someone investing $50K into syndication. So oftentimes that actually projects out better for the passive investor in the fund versus actually directly investing into syndications. And this varies from deal to deal. It's not always that way, but it can be. So let's talk about why multifamily. So as we all know, housing is one of the three main needs. People will always need housing. There's long-term demand for it. And the population is always growing. So this is one reason that I think housing, especially multifamily, will be a great asset for years to come. As the home ownership costs are going up, the delta or the gap between renting and home ownership, it keeps getting bigger. And this will drive more people to become renters in the future, which is a good outlook for multifamily. It can also be an inflation hedge. If you have your money in a savings account, you're actually losing money every day. If you have a savings account earning, let's say, less than 1%, you basically are lighting dollar bills on fire every single day. Think of that. It's basically, like lighting dollar bills on fire, because the rate of return of your investment is less than the rate of inflation. So it's important to look for something that gives you a return better than what your savings account can do, or even possibly your retirement account. And there's ways to invest your retirement account into multifamily assets. Talk to your tax professional about that, but there's definitely ways to do that. Another reason multifamily is a strong investment, there's a lot of institutions, large institutions, that buy a lot of multifamily. It's a proven model. It's been proven for years, and I think it will continue to do well for years to come. You also have long-term appreciation. So you have long-term appreciation plus all the cash flow plus depreciation via tax strategies. So just overall, there's so many good things about multifamily, so many tax benefits and overall benefits to owning multifamily. I think it's, in my opinion, the best investment out there. Another reason you might want to invest into multifamily as a passive investor, your capital works for you while you don't. I like to think of it as having each single dollar being a little soldier for you, going out and fighting for you and bringing back a little bit of return on each dollar. So that's how I like to look at passive investing, putting your money to work for you while you're not working. But what makes a good deal and a great sponsor? So at Jakari Capital, as a fund manager, we evaluate deals for you. We choose only the best investments. We only present the best investments to our investors. And this helps you minimize your downside risk, especially if you don't know what to look for in a deal, in an operator. Some red flags to look for in an operator. Let's say they're not very transparent. That's something that should raise a red flag. If they're not willing to share past experience or track record, that's a red flag. If they just have no experience at all and they don't look professional, I think that's a red flag as well. Now let's talk about the deal itself. What are some deal red flags? I think debt risk is a big one. Let's say they're over leveraged. That could be a very risky asset to invest in. Some debt metrics to look for are LTV, which is loan to value, or DSCR, which is the debt service coverage ratio. And I think DSCR is one of the most important ones. This is basically the property's ability to service the debt. And again, I have more in-depth explanations of this on my website, so head over there to check out the free resources there. Another red flag on a deal of some aggressive rent growth assumptions. This is a very easy metric to manipulate, and it can really change the returns on a deal. So make sure they're conservative in their rent growth assumptions. Another one is the pro forma rents or the stabilized rents. Make sure they're in line with what the market can do. This is also a very easy to manipulate metric. So definitely check out the pro forma rents as well. Make sure they're in line with what the market can do. Another big metric that can be manipulated is the exit cap rate. So a conservative exit cap rate would be something that is higher than the current market cap rate. So let's say the current market cap rate for this offering is 6%. Ideally, we like to see the exit cap rate at 50 basis points higher, at least on the exit. So let's say 6%, we like to add 50 basis points or 0.5%. So that would make the exit cap rate 6.5%. That is all a projection. We don't have any way to predict the future, but we need to make conservative guesses on what will happen. And ideally, we'd like to sell at a lower cap rate. But the reason for the conservative approach is to make sure we underpromise and overdeliver on any investment. So what separates math from trust? Like I said before, you can make any deal look good on paper. So really knowing how to look at different metrics, how to read financial models is key to making investment decisions. So if you're unsure of how to do this, I think that's another reason you could go with a fund manager like myself. We know what to look for in financial models as well as sponsors to help you minimize downside risk. And again, I have some great resources. I know I'm beating a dead horse, but I have some great resources on my website. So please feel free to check them out. I think you'll get great value from them. How do we align our interests with yours? So as a fund manager, my goal is to not make money before you do. So how do we make money as a fund manager? We might charge an acquisition fee. This is an upfront fee and all of the capital that we raise. This just compensates us for our time, our resources spent into finding deals, evaluating them, and evaluating sponsors, doing the work that you don't need to do. We might charge an asset management fee. This is a fee that we might charge to do investor updates, etc. The time that we need to put into actually managing the fund. Then we have the fund fees as well. There's fees associated with running a fund, startup fees. We have annual fees that will come in, such as accounting and reporting, things like that. And then let's talk about the promote structure. Typically on a fund, the structure will look like anywhere from a 90-10 split to an 85-15 to even an 80-20 split. The 80% going to you as the LP and the remainder going to us as a GP. And on top of that, we offer preferred return. Typically, a preferred return would be anywhere from 5 to 10%. Just depends on what the actual parent offering looks like. This ensures that you're getting cash flow before we do as the fund manager. Another way we align interests is we return all of our investor capital invested back before we earn any promote on the deal. So this ensures that interests are aligned, because in order for us to make money on a deal, you have to make money first. And so we're incentivized to find only the best deals, best operators to invest into. And this is, I think, a big reason why a fund might be a right fit for you, especially if you're a busy professional. I'm just looking for some places to deploy capital that are alternative investments to the stock market, to your savings account, etc. If you're looking for transparent investment opportunities that don't require your time, I'd love to have a conversation with you and see if I can help you with any investment needs. We only share deal opportunities with investors we build a relationship with. If you're interested in learning more, let's start a conversation to see if it's a fit for you. Again, feel free to reach out to me via LinkedIn, any kind of social media platform. You can check me out on my website. I'd love to schedule a call with you as well if you're interested in learning more, have any questions about passive investing. Thank you for watching again. Remember, future is bright. Keep climbing, and I will see you on the next one.